All right. Hello, everyone. And thank you for joining this episode of Calling All Real Estate Investors. We have a very special guest today. We have Tanisha Souza here. Thank you so much for joining us. And we just wanted to remind you all that you can connect with us at info@ridgelendinggroup.com, or you can always call us at 855-747-4343. If you have any questions throughout this meeting, please pop those in the chat. We're going to do it a little differently today. We're going to wait till the end of the presentation to answer those questions. So you can feel free to pop them in as you have them or save them for the end. So whatever works best for you. And then I'm going to hand it over to Caeli Ridge to do an intro for Tanisha.
Thanks, Carly, honey. Hey, everybody. As always, thanks for being here with us today. Love the participation as usual. I think that this is going to be a really special hour or so of your day, of your lives, I suspect. Very, very excited to introduce my colleague and friend, Miss Tanisha of Tardus Wealth Strategies. I'm not going to steal any of her thunder, so I'm only going to briefly kind of explain, because I know that some of the posts, social media posts and stuff, didn't go into any great detail, but I'll just kind of give you the concept of the wealth building that Tanisha and Tardus provide for its clients and investors. There are, and I apologize. She did. Okay. Thank you. Sorry, guys. There was somebody standing in my door, and we're live, and this is recorded. She's going to detail for us today how to effectively leverage multiple streams of income using arbitrage and real estate to achieve some real true financial freedom. There's something that is coined, in fact, trademarked by Tardus. She's going to be talking about in great detail, called the Income Snowball. I think you're all going to find this to be a light bulb, right? In fact, maybe even life-changing for some of you. I've been following this for a while. Tanisha and I go back maybe 5-6 years now. I have been invited to participate in some of their in-person events. Even, over the pandemic, we did some remote, virtual things. Anyway, I'm a big fan of everything that they do. They also pride themselves on education, which is very true to my heart. So without further ado, let me just introduce. I have my notes here, so I want to read those so I don't screw it up. And then Tanisha will take over. So Miss Tanisha is an author. JD, which, by the way, I had to look this up. Tanisha, in her little bio here, you guys, I got it. Tanisha Souza, JD, and that is Juris Doctorate. Okay, I'll get there in a second. Is an author, patent holder, professional speaker, wealth and passive income coach, and entrepreneur. She has a passion for teaching people how to live their dreams by quickly building passive income without risk. You heard that right, without risk. Tanisha quit the practice of law after replacing her income with passive income from real estate, and she launched Tardus Wealth Strategies, a full-service wealth and passive income coaching firm. Tanisha studied and obtained her bachelor's degree at UC Berkeley and obtained her Juris Doctorate from USC's law school. Tardus has helped over 7,000 clients in their 20+ years in business, almost entirely through word of mouth, by the way, so that should tell you something. Anyway, without further ado, Tanisha, take it away.
Right on. Thank you. It's a pleasure to be here. And like she said, I mean, Caeli and I don't know, I think, were you here in Maui? I think we did the ATV ride. I'm not sure it was in Kauai.
I was there, yes, in last October or something. Yeah.
That was awesome. So hope to get you back out here pretty soon. All right. Hopefully everybody can see my screen. Let's see. Does that look good?
Yep.
Okay. All right. I'm going to jump right in because what I want to do is show you guys how to build a real estate portfolio fast in any market. And I know a lot of people are like, well, is now the time to buy? Maybe it's not, interest rates, all that kind of stuff. You know what? There's always deals in every single market. And in fact, I know maybe a week ago or something, I contacted Caeli because I was like, hey, I'm looking at this property that's at auction. And, I'm looking for, this type of financing. And she was super helpful. So bottom line is, if you want to learn a new way, a faster way, something that is really the wave of the future, you're going to want to really pay attention to what I'm going to share with you today. All right. Okay. So real quick disclaimer. We are not financial advisors, so we don't sell any type of investments. We don't have any relationship to any investment platform. So everything that I share with you is educational, and it will be enlightening, right? So we do coach people on how to invest, and especially the Income Snowball way. I'm going to give you an overview of how it works, what we do, and just give you some really strong tools in your tool chest to be a very competitive investor. Okay. So, Caeli already gave you the intro of me, so I'm not going to say too much. All of that just means everything she said is that I was a disgruntled attorney and I wanted to quit doing what I was doing. And so I needed to create enough passive income to cover my living expenses. And as soon as I did that, I was able to quit my job as a lawyer and start this business. And it underwent a lot of iterations over the years, but we've been very successful, A+ rating with the Better Business Bureau, and helped a whole lot of people. So excited to share with you what you're going to learn today. So just some quick bullet points on what you're going to learn today. And I think a lot of this is going to be very new. I've noticed a couple of names of people who are on this podcast. So I know you're familiar, but I think most of you won't be. So let me just share with you what I'm going to learn, what I'm going to teach you. So you are going to learn how to buy rentals without using savings, and it's not the BRRR method, the BRRR method, typo in there. Okay, so we're not talking about flipping, buying discounted, flipping, and then refinancing, renting it out from refinancing and doing all that. That's a great strategy. It's very active. What I'm talking about here, what I'm sharing with you is truly passive income. And of course, you can get that through just renting your rentals, but you can actually build your portfolio a lot faster. I'm going to show you how to acquire multiple assets with the same dollars. So with the same dollars you have right now, and let's say that you don't have anything in savings, right? You don't have to have anything in savings to do this. You just need a little bit of cash flow, a little bit of leverage and arbitrage. And then we're going to show you the rest of, how to do this. If you want to learn how to build your rental portfolio fast, faster than traditional ways, typically, and to do it a lot differently. And I'll share with you that too. You're going to do one thing that you're going to do differently than the way you would traditionally build a real estate portfolio is by creating massive monthly cash reserves, because in a lot of cases, one of the issues that happen with investors, and if you are investors, you know what I'm talking about, is inevitably something's going to need fixing. You're going to need to do something with that property. And if you've already made some repairs, something just, broke or, whatever it was, that could wipe out your cash flow. So what we're going to show you is how to create massive monthly cash flow reserves with multiple income streams. And you'll always be prepared for real estate buying opportunities. So if you're interested in growing and building and doing it safely, so you're not totally over leveraged, you're not in any of those situations where if the economy goes south, you're in trouble, you owe more than what the property's worth. We're going to show you how to get around all of that and also be able to purchase when you're ready. Okay. All right. It's tall order, but I'm going to try to go through this kind of quickly. And I'll try to also leave some questions at the end as well. So just a quick bullet points on the Income Snowball. Before I went for the patent, we took over 6 years in research and development. I actually employed a woman, one of my clients, who was she was a graduate of Harvard, and she had a math degree, and her father was also, it's kind of passed down, I guess. He was actually a professor, and he had a degree in, mathematics. So I was able to work with them to help develop the software behind it. And that's what I really actually have the patent on. It forecasts your financial freedom date. And again, your financial freedom date is a date where you can draw out of your investments the amount of money you need to live. And that means just covering your living expenses. So I'm going to give you an illustration. I'm going to walk you through from start to finish so you can see how this can help you. Before you even start, it will tell you your financial freedom date. If you do these things, invest in these things at these periods of time, and do it this way. So the calculator is very important. And then the coaching aspect is very important as well. So on average, the average person is able to, reach financial freedom in 5 to 10 years. Okay. And so, and that's regardless of the assets that they're using. But we've been dealing with for the last year and a half, just a lot of people that want to grow their portfolios. And now, you're going to see a lot of opportunities to really do that, as long as you're in a position to be able to jump on it. So I got the patent in 2014, and the rest is history. Now, so let me just kind of get into the details of how this whole thing operates, the Income Snowball system, and then how the coaching actually fits in. So cash flow is king. I think we all agree on that. If you listen to any of Caeli's podcasts, that that's really, something that you should always be looking for. Cash flow is important in business. It's important in real estate. It's important in life. Like if you don't have any cash flow, you're going backwards. So the first thing you need to start this whole system is a positive cash flow, right? If you're breaking even or you're negative cash flow, that's not the time to start this. You want to start it when you have a positive cash flow. You don't have to have any savings. You don't have to have money piled up somewhere, right? To start, like you might to buy your first rental. What you do need is just a little bit of extra each month. So I'm going to give you an example. And some of those, and by the way, I'm going to get this question, so I'll try to answer it right now. How much cash flow do you need to start? Well, the average client usually will have between, say, $800 or $1,000 extra each month, all the way up to $10,000, $15,000 or more per month extra cash flow, depending on how much money they make, the rentals, all that kind of stuff. So when we're talking about cash flow in the context that I'm going to share with you today, it's really looking at your income that you take home from your job or your rentals, right? The expenses, right? Minus all the expenses. And then the cash flow, your free cash flow is what you have left over. And that's what we're going to talk about today, is that cash flow, how to use that and use it in multiple ways to buy multiple assets. Even if it's not a lot, you might think $800, $1,000, whatever, I can do something with that. Yeah. You don't need to have $50,000, $100,000 saved up to be able to start this. It's just very little. Okay. And so, that's one of the real keys to this. So what we're going to do is assume that your monthly cash flow is $2,500. Now, why am I using $2,500? Because it's an easy round number, very easy to do, a lot of quick math to make it simple for you to understand. And so that's what we're going to use that. So the cash flow is what you have left over. Let's say that you make $7,500. Maybe that's your pay from your paycheck. Your expenses are $5,000 and you have $2,500 left over. What do we do with this, right? What are we going to do with this $2,500? First thing we want to do is get a little bit of leverage, and the amount of leverage is important, right? You don't want to just go and grab any old amount, right? You might, oh, wow, I've got a $500,000 HELOC on my house. Can I just use that to do this? The answer in 99% of cases would be no. You would never want to use too much leverage to make this work. You should always use the exact right amount of leverage for your cash flow situation. If you use too much, it's not going to work. And if you use too little, it's not going to work. So my calculator actually will give you the precise amount for your situation. So in this case, we're going to assume that the amount of leverage you're supposed to use is 10,000. Okay. And for leverage, we're not talking about a 30-year fixed loan or anything like that, or a personal loan for 5 years. We're talking about a revolving line of credit, similar to a credit card. It's not a credit card, but I'd like to use a credit card as an analogy because everyone knows how credit cards work, right? You use it, you pay it off, you can reuse it. With a loan, you get it, you pay it off, and you don't get another one unless you reapply. With a line of credit, revolving line of credit, you're going to be able to reuse it. And you guys are familiar with home equity lines. You're familiar with, you're familiar with all kinds of different, business lines, personal lines. There's different types of lines of credit that can be used, and some are better than others. So your coach can also help with that as well. Not only helping you find one, but choosing the right one for you. So now you use that, let's say that you get that $10,000 line of credit, right? My calculator, which I will actually show you a demo of that toward the end, but you use that to buy what I call short-term amortized income assets, also known as fast-burning fuel. So when you talk to anybody at Tardus, anybody who's with us, even our clients, they understand what fast-burning fuel is. It is a term we use for a type of investment. short term, in other words, 2 years, 3 years, 5 years, 7 years in length, principal and interest payments. So amortized over a short period of time. Now, why is this important? Because it gives you way more income than an interest-only investment would, or an investment that is principal and interest, but it's over 30 years. Think about your mortgage, right? Or your mortgages on your rentals. The reason why most people do not get 15-year mortgages on their rental property is because it wouldn't cash flow. The reason why they don't get 15-year mortgages on their primary residence is because the payments would be too high, right? They are looking to make those payments lower. Now, if you're on the flip side of that and you are the investor and you want income from a loan, right? Then what you're going to want to do is you're going to want to shorten that term because you're going to get bigger payments for this system, for the income snowball. Now, normally with a shorter term, the interest might be a little bit less, but the payments are so high that what we're doing is we're utilizing that additional income to help us accelerate the purchase of new investments. Okay, so that's a long way of explaining. Now, another analogy that I think helps a lot of people kind of get a grasp on what we mean by fast burning fuel, slow burning fuel, that sort of thing, because both types of investments are used in the income snowball, but we start with fast burning for a very specific reason. My calculator utilizes that, and there are lots of different types. I'll talk about that in a minute. But let's imagine that you're at like a NASCAR race or something. You're at a racetrack and you've got 2 cars that are about to race. And maybe they have to do 2 laps around the track, and you're trying to decide which one. Maybe you're going to bet on which one will win, which one will get to the finish line first, right? If you've got just a regular old Honda, Honda Civic or something, and you've got a race car, right, versus a race car in this race to make 2 laps around the track, which of these do you think will reach the finish line quicker, the Honda or the race car? Okay, well, you don't have to answer since we said we weren't going to have you guys answer until the end, but it's not your question, right? It's the race car, right? The Honda is not going to make it as fast. The race car was built for speed, right? It was built to go fast. It was built to go around the track. The Honda was meant for long distances. It was meant for, just everyday driving. So when you look at this analogy, we look at the type of fuel that goes into each car, and we look at the car or the vehicle as the investment system that we use, right? And the fuel is the investment itself. So the racing fuel we put in racing cars. Regular fuel we use in regular cars. We call the racing fuel fast burning fuel, right? It truly does burn faster than regular fuel. So we use it for some examples of that are short-term mortgage notes, peer-to-peer lending, let me go back, partials, for example, could be short-term notes, or you can just get them on, say, PaperStack or some other types of online platforms. Peer-to-peer lending like prosper.com, short-term income funds, like some of the things that you might see on ground floor. So racing fuel is for race cars, and the regular fuel is for regular cars. That's the slow burning fuel. Those are stocks, bonds, mutual funds, rental properties, right? You get a little bit of income, but for a long time, or perhaps even indefinitely. Long-term notes can also fall into that category. So we have to make sure we understand the differences, because what we use and what powers this whole thing and what makes it go so fast, so quickly, and you see so much income so fast, is because of the fast burning fuel that's used in the beginning. Now, what happens if you put racing fuel in a Honda, right? Okay, whenever I ask this question, people are like, I don't know, but there's always somebody who's listening and watching this who knows what happens, right? They're car people and they understand. You will destroy the engine on the Honda. In a real life scenario, if you're using fast burning fuel investments in a traditional investment, say like your IRA or in your 401k, or just kind of using it the regular way and just like investing your money, doing dollar cost averaging and using, investing in, say, Prosper notes or something like that, you're not going to get to your financial freedom date really any faster than you would if you were to just, put your money in just a regular slow burning fuel. So the key is putting the racing fuel in the faster investment system in order to make it go faster, right? We don't want to put racing fuel in a Honda. We don't want to destroy the engine. All right. Okay. So with that said, let me just kind of show you this, how we do this. It's basically, it's income stacking with momentum. So momentum income stacking is what we're doing with the income that we're getting. So now what we're doing is we're using other people's money, the bank's leverage. We're using the bank's money to buy an asset that produces $320 a month. In this case, it's for 3 years. Principal and interest payments of $320 a month for 3 years. Okay, you can actually, run this on any amortization table and see what that would equate to, and that's what it would be. So about $320. Now, if you're going to get this for 3 years, right, and you're going to use that $2,500 cash flow, this is how we're going to use it. The $2,500 cash flow you have, we're going to use that in addition to this $320, and we're going to pay off the $10,000, right? We're going to use the $320 plus your $2,500 cash flow to pay down that line of credit, which we could then, once it's paid off, reuse. So you've got $2,820 to pay off this $10,000 line of credit. I mean, how long would it take you to do that? Not long, right? We're talking, you're able to buy the next asset in about 5 months, right? Less than 5 months. Okay, so you're able to reuse that $10,000 credit now and buy your next fast burning fuel asset. Now, remember, what happens after you paid off the first one? After the first one, you pay it off in, say, 5 months, you're going to get payments of $320 a month for the next 2.5 years, right? Or, longer. For the next 30 months, you're going to get another $320. So even though that first investment has been repaid, you've repaid it, now you're able to buy the second one. Why? Because you have so much income. Now imagine if you took $10,000, you borrowed $10,000, you invested it, and you got interest only, and that interest was $60 a month or $70 a month, right? It's going to take you a lot longer. You're basically only using your own cash to buy that next investment. But because the cash is so huge, you're able to buy that next investment faster. And it goes faster and faster, kind of like a snowball builds as it rolls down the hill, in snow, right? It just picks up speed, picks up momentum, picks up, volume. And that's what we're doing. So that second investment now you make 5 months in, now you have $320 times 2. So you got $640 coming in along with your $2,500 to pay down the $10,000, which now it's over $3,000. So, if you're kind of starting to get the picture of this, what happens is each time you make the investment, it allows you to pay off the line of credit even quicker. So the first time might be 4 months, then, 5 months, then 4, then 3, then 2, then eventually you could be doing this every month where you're paying off $10,000. And if you're doing that, that you've already created $10,000 in monthly income. It's principal and interest, but it's a lot of income, right? Even if it's $10,000 in principal and interest, that allows you to keep purchasing every month. Now, it's never going to get to that point because the calculator actually instructs you to increase the line of credit, right? If you were to just keep that $10,000 forever, it's not going to work. It will actually stop working because when the first $320 falls off, in other words, you've been fully repaid after 3 years, you lose that first $320 in income, but now you're buying the next $10,000 investment, which is $320. So you start to flatline where you're not making any more money. You just kind of get to this point. The way that does it, and this is what makes this this patent and the calculator so special, is it knows when to increase it and by how much. So you don't have to figure it out. You don't have to think about it. It makes it super simple. So with twice as much fast burning fuel income, you pay off the line of credit in 3.1 months, right? So this is what that would look like if you started in January, for example, and you just kind of went on throughout the whole year, right? The first one, you're getting $320 a month, right? For the first, 4 months. And then what happens is you make the second investment. And now in May, you've got 320, which is 640. You can see over here, you got $640 coming in plus your extra money. And then guess what? It's a little bit faster. Now that was only 3 months. This was 4, this was 3. Now we're doing it again. We've got $960 a month coming in. Look how fast. This is in less than a year. right? And then you do it again. Now you've got $1,280 in income coming in to help you. This is in less than a year. You've got half as much as you were putting in. You've been putting in. You've been putting in $2,500 a month, and you've got $1,280 coming in because the bank's money, right, allowed you to get access to that. Now, why do we use leverage in the first place? The reason why we all use leverage is to give us more buying power. When we're buying rentals, when we're buying anything, leverage can help you as long as you use it wisely and you don't over leverage yourself. And so the calculator prevents you from doing that. Like you wouldn't over leverage as long as you're following, right? As long as you're following the system and the calculator and what it's telling you to do. All right. So in the example that I just gave you, this is what that looks like. After 10 years, the income snowball is self-sustaining, right? This big pile, this avalanche of income that you created is now self-sustaining. You don't have to contribute any of your own money, right? And for some people, it's 5 years. Some people have done it in 2.5. Those are people that really, they actually have, not just cash flow. They've got other resources to throw at this. But when you have, you don't even need that though. Right? So after 10 years, the income snowball is self-sustaining, so you don't contribute any more money, and you're able to withdraw $5,000 per month to live while the income snowball continues to grow. So if in the future you need to give yourself a raise, you need more than $5,000 per month, you'll be able to do that because the cash flow is actually producing additional income. And you still have the value of your income snowball assets. So as the assets, as they continue to, build, you're buying more and more assets, and the asset value increases each time that you purchase, right? When the calculator says, hey, it's time to increase it from 10,000 to 17 or 15 or whatever it is, you do that, and now your assets are growing. After 3 years, right, it's been repaid, but you've already purchased many, many more of those at greater values in the future. All right, now let me show you this. Now, this is what's really interesting. Let's take a look at how we can do this, how we can really build a huge portfolio quicker. I think you're already starting to get, maybe your wheels are turning and you're going, well, if I could create that kind of money, how much easier would it be for me to buy more real estate? How much faster could I build a down payment, right? Let me show you something. There's lots of ways to do this, but I'm going to show you one of the fastest and most common ways that my clients build portfolios really fast. So we're going to use that same example where you have $5,000 in living expenses and $2,500 in monthly cash flow. And what I'm going to share with you is, this is the way people normally build their portfolios, right? They're like, I've got this $2,500 in cash flow, or I've got $1,000 cash flow, and I've got to save up, $50,000 for a down payment, right? So if you have 1,000, it's going to take you 50 months, or, it's 54 months to save up for your first down payment to buy your first house. If you have 2,500, it would take you a little bit less, right? A little bit less than 2 years to save up for your first. Now, if you could find properties in the $100,000 range, and I'm going to show you an example of that, right? You can do that. We actually work with quite a few turnkey rental providers. So if you don't already have one, we can refer you out to ones that we work with and that understand the snowball, and they're actually doing this themselves as well. But if you can find, in this example, I'm going to show you how, if you found properties in the $100,000 range, say in the Midwest and the South, that produce $300 to $350 a month in cash flow, and you wanted to build a portfolio, right? You would need to save your $2,500 a month for that down payment, that first down payment, which would be about $54,000 to put, to be reasonable in that down payment. Now you could try to do 25% or something, but most likely the cash flow would be so little that it wouldn't help you. Okay. So if you want to build an 8 rental portfolio this way, right? The old fashioned way, the traditional way, the regular investment style way, that's going to take you about 10 years, right? On average, roughly about 10 years. And you would have created about $2,500. You would have created about $2,500 in passive income with that. Okay. Per month, which is not huge. All right. Now, what could you do besides that, right? If you didn't want to go this route and you thought, if it's going to take me that long, I'd like to at least create more cash flow, because if your living expenses are $5,000 and you created $2,800 in usable cash flow, that's free cash flow after your property management fees, your taxes, insurance, and your mortgage payment, you're 300 to 350 a month, you're a little bit less than 3,000. You still have $2,000 more to go. You can't quit, right? You can't quit your job yet. You still need more rentals to be able to create the cash flow you need. And let's say that you were really lucky and you did have $5,000 worth of cash flow, free cash flow from your rentals. Would you feel comfortable living on that? Because if anything goes wrong with one rental, or you just don't get rent, or it's late one month, you can't pay all your bills. So what you need is that cushion, right? That additional cushion to make your real estate portfolio not only produce better for you, but also just really safer, a much safer way to play. Okay. So this is an example. What I want to show you is, this is something from Bruce stock I found. It's $100,000. And let's say that you wanted to put down, say, 54,000 or 54% down on this rental property, and you could find properties like that. Okay. Let me just kind of go through an example of a two-year investment, 9%, and you're going to buy 8 rentals. Okay. So this is the same thing, but you're doing it the Income Snowball way. So this is somebody that brings home $7,500 a month with $5,000 in living expenses. This is my calculator, by the way. So I'm kind of giving you a behind the scenes, under the hood look, so you can understand how this whole thing works. Now, what you'll see is the financial freedom date is 2034. So that's about 10 years, roughly about 10 years. And the withdrawal amount, the amount you'd be able to withdraw from your $20,000 or $21,000 in monthly income you're producing at that point is about $7,200, which would cover your $5,000 expenses and another $2,000 in rental expenses. Okay, so you've got at the end, right, at the time that you reach financial freedom, which again was May of 2035 or 34, sorry. You have generated about $20,985, and you have $7,200 available for expenses. You can draw out that, leave the $13,741 in, and that will keep it growing. Okay. And at that same point in time, you have 8 properties worth $100,000 and other assets totaling over $1 million in assets in that period of time. And you're not over leveraged. Each one of those is only leveraged about 50%. In addition to that, we're assuming that the rentals haven't increased in value, which of course, I'm sure they have. You've got your depreciation. You probably have more cash flow than what we're sharing with you there. Now, right before, right, in April, right, you're still putting in your income and taking your expenses out. But after that, you have $20,000 in income coming in from the, $15,000 in income coming in from the other assets, the fast burning fuel. And you've got $5,300 coming in from and that's before the mortgage, coming in from the rentals. So the expense breakdown too, as you can see, is your living expenses of $5,000 plus an extra $2,200 for your rentals. Now, if your rentals need more income from that, you've got an extra $13,000 coming in each month. Now you can see how fast the line of credit's being paid off, right? We're looking at 3 months, 2 months right there between the 15 and it jumping up to 22,500. This is the monthly amount that's being invested with the line of credit. So it does increase, right? We want to increase it over time, and you're building such great credit, it's easier to do that at that point. Now in April of 2027 is when you buy your first rental, and we're taking $54,000 out and we're investing that. And then the other $59,000 goes into the fast burning fuel. And that keeps happening until you buy 8 rentals consecutively, right? But we're talking 2027, which is only 4 years from now that you're able to start buying your first rental, and just buy them consecutively and every few months. So this is how you can build it really fast. Suppose if you have no savings, right? And you don't want to necessarily take all that time to build it and not have enough cash flow. We're talking $20,000 or $21,000 in monthly income minus your expenses with $13,000 to spare each month, right? Pretty, I think that's pretty significant. And it's something that you don't really see in other methods of investing, and you can just build a portfolio so much faster, so much easier, and with so much less risk than you would the traditional way. Now, so just kind of looking at the both ways again, I'd shared with you, if you wanted to build an 8 rental portfolio the Tardus way, you were looking at roughly 10 years to do just by saving your $2,500 a month. and you don't have enough cash flow to actually retire, right? You're going to need more than that. And what you would want to do besides that is not just build your cash flow up to the 5,000. You would need more than that just to make sure that you could cover your bills in case one of your renters doesn't pay. You don't want to be in a situation where you can't pay your expenses. You want to be able to quit your job and not look back and not have to go, work at Walmart, whatever, because you don't have enough, right? So this really does a trick. Building your real estate portfolio the slow way, the traditional way, 8 rentals generating $8,000 in monthly income, which is maybe $2,500 to $3,000 in cash flow after all the expenses, not enough to stop working, right? In the illustration I just gave you. In the same time frame, you can build your real estate portfolio the fast income snowball way, generate by 8 rentals that generate $8,000, and then you have an extra $13,000 as well, an extra monthly income, actually. And so the total between that is $21,000 or $20,800. And you've got that extra $13,000 that's really producing and continuing to grow for you. All right. So that's a lot in a very short period of time. And I'm sure that a lot of that was very new concepts. So I will open it up for Q&A, but the main thing that I want you to get out of it is that you are able to build a portfolio, be ready for opportunities. Can you see how having all that extra cash can help you with opportunities? It can help you in any market. You can be ready for even things at auction instead of, utilizing cash that you might have. If you have cash, you definitely want to do something with that as well. And you can do something with that with the Income Snowball as well. Like I said, there are some people that are able to do this in say 2 years or 5 years. And they're able to do that because they have more resources than the person that just has cash flow. But if you just have cash flow, imagine that. I can't see another way that you could take $1,000 a month or $2,000 a month and really become financially free in 10 years with the traditional methods, right? It'd be very difficult, and it certainly wouldn't be passive. I'm not sure exactly what you need to do to make that happen, but it would be a lot of work. This is passive income coming in from multiple sources. It's really a great way. So now what I want to offer to you is a strategy session with one of my coaches. It's completely no obligation. It's always 100% free. They'll review your goals and plan and just make sure it'll work for you, because we do offer a guarantee. And so we always want to run your numbers and see if it'll work. We'll let you know if it doesn't. It's kind of rare if it doesn't, but if your cash flow is really low or there's some really extenuating circumstances, even people that have, they work commission jobs. And so maybe they're, a real estate agent and they get paid once every, 3-4 months when they make a sale, when they close on their next home. It's perfect because now you've got that consistent monthly income covering kind of those basic expenses for you while you're waiting for the next sale to come through. So, commission salespeople love this. It's really great. And it really helps them to get to that position where they want to go. So I'd recommend a strategy session. I will provide a QR code so you can scan it. I saw some people in cars, so I don't know if I don't want you to get in a car accident. Just watch this later if you, and then just take your phone and use the QR code, just scan it. And you'll be able to register for a strategy session, and we'll know that you came from this podcast. What they'll do is they'll create a personalized plan for you. And what you'll see is the numbers will be completely different than what I shared with you today and what you saw on the calculator, because everybody's situation is individualized. So your cash flow is different. The amount of leverage you'll use is different. Probably your risk tolerance or what kind of investments you want to use will be different. And so all of that you're going to talk with a coach about, and they will devise a plan for you. They'll present it to you, and then you can decide if you want to work with us or not. If you're like, hey, yeah, that looks good. I want, what's my next steps? They can walk you through that, with whatever lines of credit. And do you need to use a line of credit? No, you don't. Some people have cash. They want to start with that and get their line of credit later. They can do that. But obviously, the reason why we use leverage to buy rentals or even our primary residence is so that we get bigger. We have more buying power. Right? I mean, if you had $200,000 in cash, yeah, you could find a property to live in. You could buy a $200,000 house somewhere. Most people don't want to do that. They'd rather buy a $500,000 house, a house that's maybe nicer or a better neighborhood or something like that. So they would borrow the rest of it. They put that money down and they borrow the rest so they could get something bigger or better. It's the same idea. You're able to invest more when you're using the bank, other people's money, as you know, right? You're all familiar with that. That's why you're here. That's why you listen to Caeli's podcast. She teaches you how to do this, use leverage the right way. And so we're going to show you the same thing, but in the Income Snowball system. So plugging that into the fast burning fuel, the arbitrage, all of that, okay, with a personalized plan. And they will give you a financial freedom date as well. We also provide one-on-one coaching. So you get one-on-one with a coach each month who's looking at your precise details, making sure that you're following everything to a T. And then we have group coaching sessions on a weekly basis. You can jump on any of those with any of our other coaches and ask general questions on those as well. So really great opportunity to just to find out if this is actually something that will work for you. And then once you see if it does and what your results could be, then make your decision as to if this is something you'd like to pursue. Okay. So again, we're experts at cash flow. That's what we do, right? So even if, let's say that you're at, only have about $500 a month, she said 800, you know what? It's still worth it. Just talk to a coach because they can actually help you find cash flow you didn't know that you had. And, we really want to make sure that every person's successful and that they will exceed our expectations and the projections. And that's why we only take clients that we know this will work for. So we have to run your numbers before we will allow you to be a client. We're also going to show you, the coach teaches you when to increase your leverage and investment amounts. Obviously, the calculator helps with that. But if any changes happen, say your income goes up or down or anything like that, we can make those adjustments to the calculator, which will adjust the schedule on which you make new investments. They'll help you choose investments wisely, have a plan A, B, and C for every investment that works for your personal situation, and also what to do if an investment ever doesn't perform as you expect. Let's say that your rentals, let's say you have rentals right now that are performing as you expect. Your coaches are going to show you how to make those investments perform or how to exchange for properties that do. Okay. Well, those are some of the things we educate you on. Stay accountable, gain clear action steps, invest and pay off debt at the same time. If that's something you want to do, if you're like, hey, I'm over leveraged on a couple of rentals I already have right now, guess what? We're going to show you how to create income and pay it off at the same time so that you do get more cash flow from the existing rentals. So many options, so many ways to do this. I mean, I could go on and on and on, but I just kind of wanted to give you that overview. So again, we have a special offer for webinar attendees, free strategy session with a wealth coach, which includes your own personalized plan and a demo of the Income Snowball calculator. What I will do for the first 5 people who I'm like, how many should I do? Because it's actually a lot of work for me. But what I'll do, and this is just for Caeli's group, is I will actually do a video for you that will explain what we believe is the right strategy for you. So we'll, when my coach, when one of my coaches comes and gathers your information, we'll plug it in. And then, like I said, I will give you a video that will explain what I think about your strategy and why we chose to, do it that way. Your coach, the coach that you get assigned to will explain all of it to you. But like I said, the first 5 people also get a video from me with a little bit more detail as to the strategy. Okay, so this is the QR code I was talking about. Take your phone, snap it, and you will be one of the first 5 to get the webinar. So I know there's a lot of people that aren't on live, so they're not going to be the first 5, I'm sure, but still it's free. It's definitely worth checking out so that you can be in a great position. There's so many deals happening right now. It's crazy. So that's it. All right.
I've got questions.
We do. We have questions. Okay.
I'm starting. I get to start since I'm hosting.
Okay.
First of all, this was amazing. Thank you so much for doing this. I really think there's going to be a lot of people that can take advantage. And by the way, I didn't realize that you guys did that one-on-one analysis for free, which that's how we do it, right? We do a lot of the front end stuff, and we put a lot of time into working with our clients and the qualification, all the stuff that goes into that, and we don't make a dime. And I really feel like, for me, especially, putting your mouth where your money is, or your money where your mouth is, whichever way that goes. That speaks volumes. So very, very cool, Tanisha. I have a couple questions though. I'm just going to jump right into it.
Sure.
And you partially answered this, but how do the numbers, and I know we probably don't have time to go back through the simulator, but how do the numbers change for the person that has a bunch of their own cash that's just kind of sitting idle, not doing a ton? So maybe they use some leverage, as well as they throw $50,000 or $100,000 into this thing. It accelerates it in terms of the interest, because they're not paying interest on the leverage, right? They have their own cash, but maybe they're doing a little bit of both. Does it exponentially accelerate the overall timeline?
It really does. The cash flow is king, right? So what we'll do, there's several different ways that we can do it sometimes, and it really depends on the person, but I'll give you a couple examples. Let's say someone's got a $50,000 or $100,000 sitting around. They're like, you know what, it's just sitting there. I want to do something with it. What can I do? And so we would either look at some slow burning fuel options, like, hey, maybe you should purchase a rental, because one rental property that is, produces $300 a month can speed up your financial freedom date by 2.5 years in some cases. And it really just depends on if you're using your own cash as part of that, that will accelerate it dramatically. But let's say we weren't going to do that. We're going to actually use it as artificial cash flow. So if someone has, say, $1,000 a month, but they've got this $100,000 sitting there, we can do what's called artificial cash flow. We'll pull out $2,000 to $3,000 a month, for example, of that 100, and drip it through the whole system. So we're doing two things. One, we're leaving some of that money available for an opportunity that comes around, or for maybe still burning fuel, but we're also going to use portions of it, and it actually speeds up what we call the flips, the investment. So you do the first investment, now you're doing the second, you're doing it so fast. Happens a lot too with people that get these big bonuses kind of out of the blue. They're like, oh, they have $1,500 a month cash flow. All of a sudden they got 20 grand, boom. They're able to do, like, we call them flips again, but they're investments. They're able to do 2 or 3 more flips in 1 year than they normally would have done, which accelerates the whole thing. You've got 2 to 3 times more income coming in for 3 years or 2 years or 5 years or however long the investment is that you're making. So,
okay.
Yeah.
Very, very cool.
Yeah.
What about, does Tardus, I assume Tardus is going to be the one integral in choosing the investments that the leverage, the arbitrage is being placed into, right?
Yeah, well, what we do is we don't choose the investment for the client, but what we do is we show them the investments that work with it. So we'll go and we'll say, look, we need to develop criteria for you, right? So what type of interest are you looking at? You want 6%, 4%, you want 10%, 12%, what do you want? What's your risk tolerance? We go through all these questions. Once we find that out, we're like, okay, so these are the ones, this is the range that you should be looking at. Don't look at 12%. You're going to have a heart attack on those. 4% is way too, low for you. So this is what we're going to look at. So these are the investments. Now, this one requires this much work, right? Or this one, you're going to have to do this much education first before you start investing. This one's easy. You can do this right away. Doesn't require. So those are the things that we're looking for. And those are the questions we ask to help the client figure out what's the best fast burning fuel investment for them to start with. Okay. So it's a pretty extensive analysis. But what it does is it makes the clients, they know exactly what they're doing. They're happy. The investments work for them. It's just so much better that way. We also already have a plan, again, for what to do if your investments don't perform as expected, right? They already have a plan A, B, and C. Obviously, the higher interest you get, the more volatile the investment might be. But what's nice is with all of these investments, pretty much what you're getting is a fixed payment each month. With, say, Prosper, the payments fluctuate a little bit depending on defaults. With something like the income funds that have been produced for the Income Snowball, or for things like what you'd find in Ground Floor, the payments are fixed, but they might be a little bit, instead of getting it for 36 months, you might get it for 33, or you might get it for longer if the investment outperforms what it was given, but the payments are the same. So that's what's so nice, is you can count on predictable recurring monthly income. And we're going to take all of those things into account when building the plan. It's pretty cool.
That's totally passive. Once it gets going, totally passive. Yeah. Okay. I had one more question, and then you guys can have the floor. I assume, another assumption, Tardus will have some access or at least show whomever your clients are where to get these lines of credit, or are they on their own to find that?
Absolutely. No, so we will actually recommend places if they don't already have a line of credit. A lot of people already have lines of credit, but if they don't, we'll actually recommend where to go, how to get it, you know, what your application should look like, all that kind of stuff, and we'll point them in the right direction. So, you know, a lot of people have a lot more resources than they think, or, you know, what we don't want them to do is run out there and try to get one and they do it wrong. So they ask for the wrong type of line, or it's, you know, it just, you know, and then they're like, sorry, that's not going to work, and have to go back and redo that, you know?
Well, segue in, guys. I mean, this would be a good opportunity to also, and you guys, I talk about it probably every week, the all-in-one. Okay, so, and I think, and Tanisha, you can correct me, I think that in many cases, maybe most cases, please, I know you will, but that is a perfect vehicle for something like this.
We have a lot of clients using the all-in-one for this. I mean, it's phenomenal for this. I know there've been a few changes recently, but you know, for clients that have been using it, it's great. It's great. I mean, you know, you need a primary residence usually, but in some cases you can also do it on a rental.
Yep. Yeah, thank you for bringing it up. There have been some changes, gang, to the all-in-one. I'll talk about that maybe next week. I don't want to take our time on that today. But so, okay, thank you for answering those. Is anybody, I'm sure there's questions, Carly. What do we got?
Yes, we do have a few questions. So I'll start here with the one that came in earliest. So this one's actually for Caeli. Is there a time frame, or maybe for both really, but is there a time frame one should have this type of income before using the proceeds of the income snowball to qualify for a mortgage if the snowball is 100% of your income?
You know what? So let me just see if I understand what this person's asking. So they probably don't have savings, right? And so they would be using the income snowball to build up a down payment for rentals. Is that what I'm getting from what you just asked, or?
Yes, I think so. They're anonymous on here, so I wouldn't be able to ask them, but if you do want to say something in the chat, let us know, please. But yes.
Okay. So, you know, it's either way, but in a lot of cases, if you're struggling to build up the down payment, what I would do is use the income snowball. You can see how quickly you can create income. And that's not the way that I shared with you how to buy multiple properties is not the only way to do it with the income snowball. There's so many ways to do it. You know, there are people who have been able to use the excess cash flow that they've created to just save up for the first down payment faster than they could with just their $2,500 alone, or whatever their extra cash flow is. So there's many, many ways to do it. I don't have enough time in one or even 3 webinars to show you all the different ways that you can do it. But if that's something that you're wanting to do, build a portfolio, and you're like, how do I do this? And you only have a little bit of cash flow, I would say definitely get a strategy session and see. It'll tell you right away whether or not this is how you should start it out.
Same thing here, guys. How many times have you guys heard me say the math won't lie? Right? The math won't lie. So similarly here, if you take the time, they're taking their time for free to give the details and the numbers, you'll know for sure whether this is an option for you or not, and how it looks and how long and all that stuff. For free.
Yep.
All right. The next question here, does the model take into account syndication opportunities that really are more about back-end capital gain versus cash flow?
Yes, you can add any type of investment to it. So for a real estate syndication, in fact, let's see, we've used all kinds of different investments in this thing. The key though is the fast burning fuel is what gets it going. You can add any type of investment to it, layer it on, like rental properties, real estate syndications, all that. What we need to know is what the expected exit or the expected lump sum will be at the end, and when that will be. And we just plug that into the calculator, and then it takes everything into account, and it will tell you this will speed it up by this much time, or it won't, or whatever. You know, some people use life insurance, by the way, as their lines of credit. So we'll look at all those things and say, oh my gosh, you've got this much cash value in your IUL or your whole life policy. you can borrow this much against it. And then, a lot of agents that we've worked with, insurance agents, and we don't sell products. Okay. We don't sell any product whatsoever. We're just 100% coaching. So everything we do, we want to make sure that it works for you. We don't have any interest in, we don't care what you buy as long as it works. So the calculator will, doesn't lie, and it will tell us. But there's so many different avenues and things that you can use with this, just broaden your mind, because, you'd be surprised at all the things you can do with this and the investments that will work.
And by the way, guys, for anybody that needs to hear this, I have no dog in this fight. I am not incentivized whatsoever to have Tanisha here. I'm not making a dime on any of this. There isn't any kind of referral back and forth. This is all for you, from them. So you can rest easy that there isn't any JV or anything like that going on here.
Correct.
All righty. So we have one here. How do you account for bumps in the road with the rental properties? Tenant turnover, making sure it's ready. Are those things also taken into the calculations, or?
100. Well, so that's the whole thing. That's what makes this thing so beautiful. Imagine you always want to, whenever you purchase a rental, you always want to have some cash reserves, right? What you're doing with the Income Snowball is you're building a monthly cash reserve, like this money that's just, an extra 13,000 or whatever, 15,000 or whatever per month. During COVID, right, when people were losing their jobs and their businesses, or they, basically had no income for a certain period of time, that happened to our clients too, right? Our clients were in that situation. Their renters weren't paying, right? And there was no rental assistance for a bit. So they had to come out of pocket to cover those mortgages. What did they do? They used the income from their snowball, right? They had all this income coming in. So what they were able to do is, well, in some cases, if they had to, they didn't even have to put any money into the snowball. Their snowball was already creating $4 or $5 grand a month or whatever it was, or $2,000 a month, and they were able to utilize that money as needed to cover those mortgages or those additional expenses, or even their living expenses during that time period. I mean, that's what it is. It is a huge monthly cash reserve. Now, you can't do that forever. Your snowball will completely, you'll utilize all your money from your snowball. But they were able to do that for 6 months or 8 months, and then start reinvesting once they got their job back, they got the rental assistance, they got the PPP loan, whatever it was, they were able to continue on. But it's a huge for emergencies. Great. I mean, that's what it's for.
Awesome. And then one more here. Can you use the income from the Income Snowball to qualify for the mortgage loans?
Well, okay. So
one.
Yeah, you can go ahead and answer that.
Well, if you're claiming the income, then yes, you can. If you guys are claiming it on your tax return, then the answer is yes. Now, typically, if it's a new form of income, you're going to have to show 2-year history of it. But otherwise, yeah, the answer is yes.
There you go.
Perfect. All righty. Well,
Did we get them all, Carlos?
Let's see here. Another one popped up. Let's see. What do you think of cash? Let's see. Cash while life policies for this. Cash whole life policies for this, maybe?
Whole life. Yeah, I think.
Yeah, whole life. Yeah.
Yeah. Well, yeah, if you have cash value in a whole life policy, you can totally use it for this. We have a lot of clients who are doing that. Some have whole life, some have IUL policies. They have cash value. It can be used. It's, basically a line of credit that you have a lot more control over. You have control over the payments and even whether you pay it back. My personal opinion is you always want to do that. Especially for this, I mean, that's what this is for. You don't want to just have a big loan out there, or, basically eat up your cash, your death benefit. But what we want to do is make sure that you utilize just enough, not too much. Again, if you've got $200,000 cash value in your life insurance policy, don't go, oh, I'm going to throw it all in there and not pay it back. Follow the system. Just follow the system, and you don't have to worry about anything. You don't have to reinvent the wheel. You don't have to I have to say this because some people get all fancy and they want to do all this kind of really crazy stuff. It's already crazy. It's already really cool. Like, you don't have to do anything to embellish it. It's already awesome the way it is. And you will be able to do some really cool things with it.
Perfect. Thank you so much, Tanisha. That's all the
Yeah.
questions that we have.
Awesome.
Yes.
Amazing. Amazing.
Yes.
Thank you, my friend. I'll check in with you soon. And I have a feeling we're probably going to have you back again if you'd be willing sometime in the, I don't know, later this year, first quarter next year to do this one more time. I just think it's so valuable. And I love the way that you guys provide the information in that abundance mentality. You know, it's super cool. Okay, well, you guys, thank you for coming and being here. I don't know exactly what our content is for next week. Carly will be sending out emails and reminders and whatever that might look like. No, it's not next week. We skip a week, don't we, Carly?
Actually, it will be next week because this was a bit of a bonus episode, but we have Karen Hall coming on next week.
Okay, you guys will hear about
Yes.
that later. Self-directed IRA stuff. Tanisha, my friend, I'll talk to you soon, honey. Thank you. Good to see you guys.
Thank you.
Thanks for being here. Bye, everybody.